You know what nobody's talking about? While everyone's obsessing over gold hitting new highs, there's a mathematical anomaly happening in silver right now that's so precise, so historically consistent, that when you see the numbers, you'll wonder why this isn't front-page news. I'm talking about a signal that's appeared exactly 3 times in the last 50 years, and every single time, without exception, silver didn't just rise, it exploded. We're talking 300% gains, 400% gains. In one case, over 700% in less than 18 months. And right now, as I'm recording this, that exact same signal just flashed again. Let me show you something that'll make your jaw drop. In 1979, silver was trading around $6 an ounce. Nothing special. Most investors ignored it. Gold was the star. But there was this ratio, the gold to silver ratio, that hit 40 to 1, meaning it took 40 ounces of silver to buy 1 ounce of gold. Within 18 months, silver hit $50. That's a 733% gain. Fast forward to 2008, financial crisis, everyone's panicking, silver's at $9. The ratio, it spiked to 84 to 1, extreme. And what happened next? By April 2011, silver hit $49, a 444% move in less than 3 years. Now here's where it gets interesting. In March 2020, during the COVID crash, silver dropped to $12. The gold to silver ratio? It hit an absolutely insane 125 to 1, the highest in recorded history, and silver responded exactly as the pattern predicted. It more than doubled to $30 within 5 months. But here's the thing. That move to $30? That was just the beginning of the cycle. The pattern wasn't complete. And right now, we're sitting in the middle of something that looks eerily similar to those previous setups, except this time, the fundamental backdrop is exponentially more explosive. Let me walk you through the math, because this isn't speculation. This is cold, hard arithmetic. The Silver Institute just released their 2025 supply-demand report. 5th consecutive year of deficit. We're talking 115 to 120 million ounces, more silver consumed than produced, every single year, for 5 years straight. That's over 500 million ounces of deficit accumulated. Now you might think, okay, supply deficit, that's bullish, I get it. But you're missing the deeper story. Because it's not just that we're running a deficit, it's why we're running a deficit, and what that means for price discovery going forward. Industrial demand for silver hit 654 million ounces in 2024. That's a record, and it's not coming from traditional sources like photography or silverware. It's coming from solar panels, electric vehicles, 5G infrastructure, and AI data centers. These are non-discretionary uses. You can't build a solar panel without silver. You can't manufacture an EV without silver. The average electric vehicle uses between 25 to 50 grams of silver. Tesla's ramping up to 20 million vehicles a year by 2030. Do the math. That's 500 to 1,000 metric tons of silver just for one company's EV production. Solar panel installations are projected to double by 2027. Each panel uses about 20 grams of silver. We're talking about an additional 150 million ounces of annual demand just from solar in the next 3 years. But here's where the mathematical inevitability kicks in. Silver mine production? It's actually declining. 2024 saw a 2% drop in global mine output. Why? Because 70% of silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices are weak, mines shut down or reduce output. And guess what's been happening? Copper mines in Chile and Peru, the world's largest silver-producing regions, have been dealing with declining ore grades, water shortages, and political instability. There's a mine in Peru called Cerro de Pasco. It used to produce 3 million ounces of silver a year. It's now producing less than 1 million. Why? The ore grade dropped from 8 ounces per ton to 3 ounces per ton. That's a 62% decline in productivity from the same amount of rock. And it's not just one mine. This is happening globally. The average silver ore grade has fallen from 12 ounces per ton in 2005 to less than 6 ounces per ton today. You're mining twice as much rock to get the same amount of silver. That means higher costs, lower margins, and less incentive to expand production. So you've got demand going vertical, supply going horizontal at best, and a 5-year accumulated deficit that's draining above-ground inventories. The COMEX, the exchange where silver futures are traded, reported silver inventories of 285 million ounces in January 2024. By November 2025, that number dropped to 243 million ounces. That's a 15% decline in less than 2 years. Now let me put that in perspective. Global silver investment demand is around 250 million ounces a year. The COMEX has enough physical silver to cover about 11 months of investment demand. That's it. And that's assuming no industrial demand, no jewelry demand, no panic buying. What happens when that inventory hits a critical threshold? We've seen this movie before. In 2011, when COMEX inventories dropped below 100 million ounces, silver went parabolic. It wasn't a gradual rise. It was a moonshot, from $26 to $49 in 4 months. But there's another layer to this that most people completely miss: the paper silver market. See, the COMEX trades about 150 times more silver in paper contracts than actually exists in physical form in their vaults. It's a fractional reserve system. As long as everyone's happy holding paper claims, the system works. But the moment people start demanding physical delivery, the whole thing implodes. And guess what's happening right now? Physical demand is spiking. The U.S. Mint sold 45 million silver eagles in 2024. That's the highest since 2015. Retail investors are waking up. They're not buying paper. They're buying coins and bars. And every ounce that leaves the COMEX vaults and goes into private hands is an ounce that's not coming back. Here's a story that'll illustrate this perfectly. In February 2021, a group of retail investors on Reddit decided to squeeze silver. They called it Silver Squeeze. The idea was simple: buy physical silver, drain the COMEX, expose the paper manipulation. Within 48 hours, every major bullion dealer in the United States was sold out. Premiums on silver eagles went from $3 over spot to $12 over spot overnight. The COMEX didn't default, but it came close. They had to change delivery rules, extend settlement times, and basically beg people to take cash instead of metal. That was a small group of retail investors with limited capital. Imagine what happens when institutional money decides to move into physical silver. And that's exactly what's starting to happen. Central banks, the big players, are diversifying out of dollars and into hard assets. We know they're buying gold. That's well documented. But silver? That's the stealth move. Because silver's market is so small, total above-ground investment silver is worth maybe $50 billion, that even a modest allocation by central banks would send prices into orbit. China's been quietly accumulating. Their State Administration of Foreign Exchange doesn't publish silver holdings, but import data tells the story. China imported 6,500 metric tons of silver in 2024. That's 209 million ounces. For context, that's 32% of global mine production. Where's it going? Industrial use? Sure, but also strategic reserves. India's doing the same thing. Silver imports hit 8,200 metric tons in 2024. Indians love silver. It's cultural. Weddings, festivals, jewelry. But increasingly, it's investment. The Indian government's been promoting silver as an inflation hedge. And with the rupee weakening, Indians are converting cash into metal. Now let's talk about the elephant in the room. The gold to silver ratio. Right now it's sitting around 88 to 1. Historically, the average is 60 to 1. During bull markets in precious metals, it drops to 40 to 1 or lower. In 2011, it hit 31 to 1. If gold's at $2,650 and the ratio reverts to 60 to 1, silver goes to $44. If it goes to 40 to 1, silver hits 66. And if we see a panic move like 2011 where it drops to 31 to 1, you're looking at $85 silver. But here's the kicker. The ratio doesn't just revert, it overshoots. In 1980, it briefly hit 17 to 1. If that happened today with gold at $2,750, silver would be $151. Now, I'm not saying we're going to $155 tomorrow, but the mathematical setup is there. The supply deficit is real. The inventory drain is accelerating. The industrial demand is non-negotiable. And the paper market is a powder keg waiting for a spark. Let me give you another angle on this. Energy costs. Silver mining is energy intensive. You're moving massive amounts of rock, crushing it, processing it with chemicals, refining it. Energy represents about 30% of the cost of silver production. And energy prices? They're not going down. Oil's volatile, but the trend is higher. Natural gas in Europe is still elevated. Electricity costs are rising globally. The all-in sustaining cost for silver production, meaning the total cost to pull it out of the ground, refine it, and get it to market, is around $20 to $22 per ounce for most miners. Silver's currently trading around $31. That's a decent margin. But if energy costs spike, or if ore grades continue to decline, that cost floor rises. And when the cost floor rises, the price floor rises with it. There's a company called First Majestic Silver. They're one of the largest primary silver producers. Their CEO, Keith Neumeyer, has been vocal about the disconnect between paper prices and physical reality. He's said publicly that if the COMEX wasn't suppressing prices through paper manipulation, silver would already be over $50. Now, you can debate whether manipulation exists, but the fact remains. The physical market is tight, premiums are elevated, and the futures market is trading at a discount to physical. That's not normal. Here's another data point that's absolutely wild. Silver ETFs, exchange-traded funds that hold physical silver, saw outflows in 2023 and early 2024. Investors were selling, but starting in mid-2024, that reversed. We're now seeing consistent inflows. The largest silver ETF, SLV, added 15 million ounces in the last 6 months. That's physical silver being pulled off the market and locked into a fund. And it's not just retail. Institutional investors are starting to allocate. Hedge funds, family offices, pension funds. They're looking at the macro environment, inflation, currency debasement, geopolitical instability, and they're adding hard assets. Silver's the logical play because it's undervalued relative to gold. It has industrial demand tailwinds, and it's got explosive upside potential. Now, let me pause here for a second because if you're sitting on $100,000 or more in retirement accounts, this is something you need to pay attention to. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold and silver into your retirement account without triggering tax penalties. It's worth checking out if you're thinking about protecting your wealth with hard assets. All right, back to where this price is headed next. Let's talk about the technical picture because the charts are screaming. Silver broke out of a multi-year consolidation pattern in early 2024. It spent 3 years grinding between $18 and $26, building a massive base. When it finally broke above $26 with volume, that was the signal. We're now in the early stages of a new bull leg. The next major resistance level is 35. That's where silver topped out in 2020 before pulling back. If we break through $35 with conviction, there's not much overhead resistance until $50. And $50 is psychological. It's the 1980 high. It's the 2011 high. It's a level that's been tested twice and rejected twice. But third time's the charm. If silver takes out $50, we're in uncharted territory. The next stop could be $75, $100, or higher. The moving averages are aligning. The 50-day moving average just crossed above the 200-day moving average. That's called a golden cross. It's a bullish long-term signal. The last time we saw this setup in silver was in 2010, right before the run to $49. Momentum indicators are turning positive. The RSI is in the 60s, which is strong but not overbought. MACD is trending higher. Volume's been increasing on up days and decreasing on down days. That's healthy price action. But technicals are just one piece. The real story is the fundamentals. And the fundamentals are setting up for a perfect storm. Let's talk about the dollar. The US dollar index has been strong for the last 2 years, which has been a headwind for commodities. But that's starting to change. The Federal Reserve's in a bind. They've got inflation that's sticky, an economy that's slowing, and a debt load that's exploding. The U.S. national debt just crossed $36 trillion. Interest payments on that debt are now over $1 trillion a year. That's more than the defense budget. The Fed's only way out is to devalue the currency. They can't raise rates high enough to kill inflation without crashing the economy. So they'll keep rates lower than inflation, which means real rates stay negative, which means the dollar loses purchasing power. And when the dollar weakens, hard assets like silver rise. We're also seeing a global shift away from the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar for international trade. They're settling oil contracts in yuan. They're using gold for cross-border payments. They're building infrastructure to bypass the SWIFT system. This isn't conspiracy theory. This is policy. And as the dollar's dominance erodes, the demand for alternative stores of value increases. Silver benefits from this in two ways. One, it's a monetary metal with thousands of years of history as money. Two, it's an industrial metal that's essential for the green energy transition that every major economy is pursuing. It's the only asset that sits at the intersection of monetary demand and industrial demand. That's a unique position. Let me give you a historical parallel that's chilling in its similarity. In the 1970s, the U.S. was dealing with inflation, a weak dollar, geopolitical instability, and a crisis of confidence in fiat currency. Sound familiar? Gold and silver went parabolic. Gold went from $35 in 1971 to $850 in 1980. Silver went from $1.50 to $50. Those weren't gradual moves, they were explosive. We're in a similar setup now. Inflation's running hot, the dollar's losing credibility, geopolitical tensions are escalating, and the monetary system is under stress. The difference is, this time the debt levels are exponentially higher, the money printing is exponentially larger, and the supply-demand imbalance in silver is exponentially tighter. In the 1970s, there was no structural supply deficit in silver. Production was keeping up with demand. Today, we've got a deficit that's been building for 5 years and shows no signs of reversing. In the 1970s, industrial demand for silver was a fraction of what it is today. Today, industrial demand is the dominant force, and it's growing at double-digit rates. The setup is better now than it was then, and if we get even half the move we saw in the 70s, silver's going to 100 plus. But there's another catalyst that nobody's talking about. Silver's role in the AI revolution. Artificial intelligence requires massive data centers. These data centers need servers, and servers need silver. Every server uses silver in connectors, switches, and circuit boards. The AI boom is just getting started. We're talking about trillions of dollars of infrastructure investment over the next decade, and every dollar of that investment requires silver. Microsoft's building a $100 billion AI data center. Google's investing $75 billion in AI infrastructure. Amazon, Meta, Tesla, they're all building massive compute capacity. Each of these facilities uses tons of silver, literally tons. And this demand is incremental. It's on top of existing industrial demand. It's not replacing anything. It's pure addition. Then there's the defense sector. Military applications for silver are expanding. Drones, missiles, radar systems, communication equipment, all of it uses silver. And with global military spending at record highs, this is another source of non-discretionary demand. The medical industry is another one. Silver's antimicrobial properties make it essential for wound dressings, surgical instruments, and medical devices. The global medical silver market is projected to grow at 7% annually through 2030. That's another 20 to 30 million ounces of annual demand growth. Every one of these demand sources is structural. It's not speculative. It's not going away. And it's all hitting at the same time while supply is constrained. Now let's talk about what happens when the market wakes up to this. Because right now, silver's still under the radar. Most investors don't own it. Most financial advisors don't recommend it. It's not in the mainstream conversation. But that's changing. When silver starts moving, and I mean really moving, it attracts attention. Momentum traders pile in. Retail investors, FOMO. Institutions start allocating. And because the market's so small, the price moves are violent. We're talking 5%, 10% days, not weeks, days. In 2011, silver had a day where it moved 12% in a single session. That's not a stock. That's a commodity with a $1.4 trillion market cap. Imagine what happens when that kind of volatility hits and the market's even tighter than it was in 2011. The options market's starting to price this in. Call option volume on silver futures has been increasing. The open interest in out-of-the-money calls, strikes at $40, $50, $60, is building. Smart money's positioning for a big move. There's also the short squeeze potential. The commercial traders, the big banks and institutions, have been net short silver for years. They use futures to hedge their physical positions. But if the price starts running and they need to cover those shorts, it adds fuel to the fire. We saw this in 2020 when silver went from $12 to $30 in 5 months. The short covering was relentless. And here's the thing about silver. It's not like gold where central banks can dump supply to cap the price. Central banks don't hold meaningful silver reserves. The U.S. government sold off its strategic silver stockpile decades ago. There's no entity with the size and willingness to suppress the price once it starts moving. It's a free market. And free markets, when supply is tight and demand is strong, go parabolic. Let me give you one more piece of the puzzle. The generational wealth transfer. Baby boomers are sitting on trillions of dollars in assets. As they age, they're becoming more conservative, more focused on wealth preservation, and they remember the 70s. They remember what gold and silver did. Millennials and Gen Z are coming into their peak earning years. They're skeptical of the financial system. They've seen 2 major crashes, 2008 and 2020. They don't trust stocks. They don't trust bonds. They're looking for alternatives. And silver, with its affordability compared to gold, is the perfect entry point. You can buy an ounce of silver for $31. You can't buy an ounce of gold for less than $2,600. For a young investor with limited capital, silver's accessible. And as that demographic starts allocating, even small percentages of their portfolios, it moves the needle in a market this small. The math is undeniable. The signal is flashing. The setup is historic. And the window to position before the crowd figures this out is closing fast. Silver at $31 today, with a structural supply deficit, exploding industrial demand, a weakening dollar, and a gold-to-silver ratio that's 50% above its historical average, is one of the most asymmetric opportunities in the market. The downside is limited. The upside is exponential. When this moves, it's not going to be a slow grind. It's going to be a rocket ship. And the people who positioned early are going to look back at $31 silver the same way people look back at $300 gold in 2002 or $10 silver in 2008. They're going to wonder how it was ever that cheap. The hidden signal isn't hidden anymore. The math is proven. The question is, what are you going to do about it?